Juan and myself are presenting first work in progress, because we thought 2 years ago that it might be a good idea to have some sort of index of convergence in the Eurozone, because in principle the Eurozone should converge if it has one currency, and therefore we want to see how far the European continental Europe has gone into has proceeded in convergence. So what we are doing is presenting to you an index full of holes and mistakes, I'm sure, so as to correct it, and then we'll publish it year by year. The index starts, the first essay we did was in 2016. Then in 2010 we decided that we should compare the convergence of the Eurozone with the convergence of the dollar zone in the United States. And then the next step will be to look at the UK, the three kingdoms in the UK, and see whether there is convergence, because I take it that maybe the UK won't be in the European Union for very long, but anything may happen. This is an annual index, and we need your critical remarks to make it better. The annual index, when we present the different graphs, you will see that the scale changes for the different indicators, and therefore one has to be very careful about the y-axis, which will give a different picture. We have mixed we've mixed the numbers for the y-axis so that it's visible, but one has to be very careful, and Juan and I will be careful in pointing out that some of the coincidences may be due to our measuring on the y-axis. Now, the idea is that member economies in a currency area should converge. That's what theory says. And we try to observe the dispersion with 11 indicators, some real, some monetary. The monetary, I think, is a good proposal, because the macroeconomic balance procedure of the Commission doesn't include money, and therefore we add money in the way that I will explain in a second. What we then do is calculate the standard deviation per country per year of the 11 indicators, and we aggregate those indicators into 4 chapters. For each chapter we've calculated the simple arithmetical average of the standard deviation per index per year. Now this is very rough, having simply an arithmetic mean for those 11 indicators, and then we go on to calculate the overall index of dispersion for the whole of the Eurozone. The index is again the arithmetical average of the 4 chapters. So we have 11 indicators gathered into 4 chapters, and then the 4 chapters gathered into one overall index. Or, well, it's good that we should use standard deviation, but you must know that we are simply using the mean in every aggregation. So let me see which. We don't insist on the optimality, never try to define it, but what we do is we assume that if you have a single monetary zone, then the optimal is that there should be convergence in all the indicators. Let me see the indicators. Right, we've done this. Okay, so these are the indicators that we use. First, the business cycle, and to see the business cycle, to see how the business cycle is different in the different members of the Eurozone, we measure the real GDP growth and the unemployment rate, because assuming that if you have if the business cycle goes into recession, then you will have a higher unemployment. The next one is public finance, and we measure the deficit as a percentage of GDP and the debt as a percentage of GDP. The next sub-index is competitiveness, and here we have the annual inflation rate in the different member countries, unit labor costs, and the real exchange rate, because all three tell us whether the country is competitive versus the others and versus the world. Now, the real exchange rate is a very important one because it is affected by internal devaluation within the Eurozone. And this is to point at Germany, because Germany under Schröder was able to pass through with the trade unionists and his party, pass through a series of measures that were the internal devaluation of Germany, and that together with the arrangement of Target 2, about which we're going to say something later, that means that Germany is in a special position, and that is reflected in the surplus of the balance of payment, the surplus of the balance, and therefore the competitiveness is an important one, and some of the members cannot attempt competitiveness. I should say, well, not only Greece but also Italy. Spain did try and achieve some internal devaluation during the crisis. The next one is monetary dispersion. It's the arithmetical average of first the contribution to the Eurozone annual M3 growth by the member state, then the credit to the private sector, and then the current account balance of each member state with the rest of the world. Finally, Target 2 balances. The current account shouldn't be in a dispersion index unless the current account is being financed publicly. If a country has a deficit in the current account, then it can go to the open market and get some loans, and this is not something that is forbidden. But in the European Union, the current account is twisted or is skewed because the deficits of different members are financed politically by Target 2 balances, and therefore it's the Target 2 balances and the fact that the ECB, after Germany passing on their credits to the ECB creates money so as to cover the deficits in the balance of payments and the basic balance of the different members. And this has explained why Greece had a 12% deficit, foreign deficit, 12% of GDP, and Spain had 10%, and so on. And this was fed by the Target 2 balances. And then we take all these and we have an overall index. We have an average, an arithmetic average of all the indicators. We calculate the real exchange rate, as I said, nominal exchange rate between Euro member states versus others, times the difference in the price index in a member state over the price index in the Eurozone. So that it's all rough and ready, but I'm sure you'll be able to suggest something to make this index better. Then what we have is the calculation of the indices, and these are two cautions that we present. The 11 indicators per country, we standardize them with 1999 as the base year. Now, this doesn't mean that convergence was good in 1999. It's simply a starting point. And we're thinking of perhaps looking at how much convergence there was before the euro, the 1999 date. And therefore, we will better this index by not having 100 to start in 1999, but by having some different measure, because there was little convergence in what would become the Eurozone. And then we use the standard deviation of each indicator, but we have to change the dates because the euro area changed in composition. 11 members in 2000, 12 members in 2006, 15 in 2008, and 17 in 2013, 18 in 2015. So this must be taken into account when you judge our index. So in one word, and before I pass my stand here to Juan, in one word, we thought that it would be a good idea to have a yearly presentation of an index of convergence, bettering and make it better. One of the things we've done is we've added the US, compared the convergence index of the European, of the euro with that of the dollar in the United States. And then we want to go and see how much convergence there was before 1999. And then we hope that with time, the difference of dates of people acceding to the euro area will disappear with the progress of the system. So now Juan is going to present the results with very telling graphs. Ya. Toma. Pasa. ¿Paso yo? Sí. Gracias, Pedro.
Well, thank you very much, Pedro. No, it's fine.
Okay.
And thank you, Jeffrey. Yeah, after this introduction by Pedro about the objectives.
Speak up.
After this very nice introduction by Pedro of the objectives of our research and what the index is meant to measure, I'm going to show you the results for the Eurozone and then for the US, and then we can compare them. But indeed, we are here to learn, and this is not just for the sake of saying it. We do really welcome your feedback at the end of the presentation, because this is an ongoing project, and as Pedro said, we're intending to publish this index on a yearly basis. So these are the results of our calculations per chapter, per sub-index, and then we'll aggregate them all in a single index. So just for you to assess this diagram properly, all these lines correspond to public finance, asymmetry, monetary dispersion, and cycle asynchronicity. They all start at 100, and this is the scale where they are measured. The only one that is measured on the right axis is uncompetitiveness. The reason for us to display this way is because the degree of dispersion is so huge, going from 100 to 900, that it shows the actual dispersion in the other indexes much better. So bear in mind that the uncompetitiveness index is measured on this axis, while the rest of indexes are measured on the other left-hand side of the chart. What they all tell you is that before 2007, contrary to the expectations of the Euro architects and the majority of politicians at the time, there was no convergence, macroeconomic convergence in the Eurozone. Indeed, in the good years. The only sub-index that behaved as promised or as expected was the cycle asynchronicity index, this one, that indeed improved before the crisis, and then obviously after the crisis deteriorated and is going back on track afterwards. That's the only good news for the Eurozone in terms of macroeconomic performance before the crisis. But if you check the other three sub-indexes, starting, for example, with public finances, well, right from the beginning, it started to deteriorate, and much more obviously within and after the crisis. So it's not.
Again, what is measured here? Basically?
This one.
Yeah.
This one is the public finance sub-index, which takes into account two indicators: the deficit of each member state as a ratio of the GDP and the debt. And what I'm showing here is that even from 1999, the dispersion across countries in terms of these two indicators deteriorated in the good years. So indeed, the dispersion between the, let's say, core countries and the peripheral economies was increased even in the good years, before the crisis. Obviously, after 2007 and 8 and within the Euro crisis, we reached to this peak, much more dispersion. And now we are approaching the 100 level, the initial 1999 level, slowly and painfully. But yes, the lesson is, even before the crisis, there was no convergence in terms of fiscal discipline in the good years in the Eurozone. As regards monetary dispersion, again, we take into account monetary growth, or the contribution of each state to the overall M3 rate of growth, private credit provided to the economy, and current account balances. That's this line, the gray line. There was a bit of a convergence at the beginning, but then from 2004 onwards, indeed before the crisis, started to deteriorate. We'll offer some explanations for that in a minute. And then, of course, within the crisis, it reached this peak of maximum dispersion, and it has started to recover until very recently.
Can you explain, if you do get convergence, how would you expect the graphs to develop?
Sorry, maybe I should have started that way. Here we have zero dispersion, and here we have maximum dispersion. And the same here, sorry, that was my mistake. That was a good point. So the higher the value of these indexes downwards, the worse the news are. Sorry, I should have started that way. That's a very good point. So actually what we are displaying here is asynchronicity and competitiveness, because the higher the value downwards, the worse the news are for the Eurozone. So if we were anticipating less dispersion, we would like these values to go upwards. Yeah? Is it clearer now? Sorry for that. And indeed, for competitiveness, this index that is measured on the right-hand side of the diagram, the news are even worse. From the very beginning, dispersion increased downwards, which means more and more dispersion in competitiveness, and reaching a peak level here in the midst of the crisis, 2009, and it has stabilized since then. But we're not really returning any closer to the value in 1999. So we do have a problem with competitiveness in the Eurozone. And that's one of the major, let's say, conclusions or results out of this calculation. This is just the monetary subindex split up in two. One, which is the solid line with our target balances. And if we think that target imbalances are of any value, of any information to offer the proper picture of the problems that we're facing in the Eurozone, we included target 2 as another component within the monetary subindex. And of course, if we include the target 2 imbalances, the monetary dispersion is much greater in the Eurozone. That's something to bear in mind.
Well, you should not call it target 2 because target 2 began in 2007. It's simply target. There's no difference between
you're right.
target 1 and target 2.
Yeah.
Forget
We need to change that. Absolutely. Yeah. Well, and then what we do, as Pedro said, is to aggregate all those, to calculate the arithmetic average of all these indicators and sub-indexes into a single figure, which is the overall index of dispersion or convergence in the Eurozone. That's the way we did it. And I really want to underline the caveats here. First of all, we don't really think that this time period is enough to measure in any way or form optimality in the Eurozone. According to Hugh Rogoff, in a paper, in a volume edited by Jeffrey Wood and Forrest Capey, it took 150 years for the US dollar monetary zone to converge towards something close to optimality, as you may want to define it. So that's a very important caveat. If we want to be fair with the euro, we may need more time in order to assess its optimality better. But having those caveats in mind, here we have displayed the overall, again, the overall index of dispersion with and without target. And we have also displayed it with the original Euro 12 versus the enlarged Eurozone membership area. So the difference between this line, the solid black line, which is the overall index for the Eurozone with target, and this one is just target balances. Yeah? If we account for target balances, dispersion is much greater. The difference between these two lines, this is for the original Euro 12 member states, and this is for the enlarged 19, is the increase in dispersion due to the increase in membership in the Eurozone. So indeed, the original 12 member states are much more homogeneous as compared to the enlarged Eurozone 19 in terms of macroeconomic performance. And then, if I may, if I have time, Jeffrey, I would like to explain a little bit more, in our opinion, why all these trends happen. But again, this is just conjectures to some extent, a hypothesis to be tested. First, the data. The only good news, as I said before, is the cycle dispersion that indeed decreased before the crisis. That's the only good news for the Eurozone. By 2006, it was half of the dispersion measured in 1999, at the time of the launch of the euro. That's very good news for the Eurozone. As regards monetary indicators, there was an increase in dispersion in 2006 and 2007 before the crisis. This is the years when we had double digits increase in credit in countries like Ireland or Spain, for example, as compared to a much more modest increase in credit in, for example, in Germany or the Netherlands. Indeed, quite a big dispersion across countries. And in our opinion, and this is again a hypothesis, this has to be related somehow to the abandonment by the European Central Bank of the first pillar as the reference value to make monetary policy decisions in 2003. As you will know, in 2003, the ECB reviewed its strategy, effectively changed its strategy, as I said, and it didn't publish the reference value for M3 growth anymore. This may be one of the reasons behind we experienced monetary dispersion even before the crisis, in our opinion. Again, public finance dispersion increased 22% again, even in the good years before the crisis. And competitiveness, this is the bad news for the Eurozone. It started to deteriorate very sharply even before the crisis. 125% accumulation in dispersion by 2006. Indeed, before the crisis. Sorry for being so repetitive, but this is very important. We were not ready, in our opinion, to face such a big crisis, even just paying attention at these very, very common indicators. And in terms of the overall index of dispersion, macroeconomic dispersion doubled from 1999 to 2007. What about the crisis years? Well, as expected, and this is nothing anomalous, let's say, in the running of the euro, all these macroeconomic indicators deteriorated all across the Eurozone, and in some countries much more than in others, and that was reflected in these indexes of dispersion. So all of them show an increase in dispersion. If we add target 2 balances after 2008, dispersion was even greater, much greater. Some remedies to fiscal differences across countries were introduced during the crisis. Devaluation policies in many peripheral economies, and you could tell the effects of these devaluation policies in terms of competitiveness, actually reducing the degree of asymmetries all across the Eurozone. That's the good news. Indeed, with the introduction of QE, since 2014, monetary dispersion diminished as well across Eurozone countries. That's also good news for the Eurozone. Let me just skip this because I'll show you in a minute. This is what Pedro introduced before. This is the situation of Germany, let's say the core economy in the Eurozone, as compared to Portugal, Ireland, Greece, and Spain in terms of real exchange rates, before and after the crisis. So from the launch of the euro, you can tell that Germany, this is the bold black line for the real exchange rate of Germany. Germany did really have a much more competitive stance as compared to the peripheral economies. So all of them, all the other economies with Greece on top of them, experienced before the crisis a massive increase in their costs as compared to German costs. And that's reflected in these sharp changes in real exchange rates across countries. That's a big problem the Eurozone is facing at the moment. And the devaluation policies, at least for Greece and for Spain, have again mitigated the effects of dispersion. That's the good news, that's the positive news. So even if it's painful, it is possible to diminish asymmetries in terms of competitiveness, but through the conduction of very painful devaluation policies, internal devaluation policies. Because of course, it is not possible under the Eurozone, under the euro, to conduct an external devaluation. What we then did is to apply the same method, the same indicators as much as we could, to calculate similar indexes for the US dollar, for the mainland 50 states in the US, in order to compare these big monetary areas in terms of macroeconomic performance. So these were the indicators used for the US economy. Again, the business cycle index, the real GDP per state, unemployment per state as well, for the 50 states in the US. Public finance the same, deficit and debt. Competitiveness, the consumer price index, but in this case, we could not have a CPI per state. As far as we know, it is not available per state. You can find it per city, per village sometimes, but not per state. So we did it per, for the 4 major economic areas in the US. Labor costs and also the real exchange rate, we did the same thing. Regarding monetary dispersion, unfortunately, we don't have information as regards the creation of of deposits and monetary growth per state in America. So we had to proxy it by deposits by households and credit to the private sector. We didn't have access to the current balance per state. As far as we know, it's not reported, it's not calculated. And finally, as we did with the euro, we aggregated them all and calculated the average to produce a single figure. This is something that I just told you before about the data. Obviously, there are very, very big caveats here we need to take into account. Really, really big. One, the USA is indeed a fiscal union with a meaningful federal budget, able to transfer resources to states in crisis in need to be, internally. So that's something very, very important to take into account. And indeed, the USA is a banking union too. So funds move all across the states, the 50 states, to attend saving and borrowing needs. So these two are very, very important caveats in order to assess the performance of these two major monetary areas. So these are the trends per index. And again, as you rightly told me before, here we have 100 and 0 dispersion. So the higher down here means more dispersion. If we start in 1999 in order to make it comparable to the Eurozone, we can tell that the dotted line is public finances. It's really good news for the US. As you know, there is for the majority, I think it's for 49 states in the US, we have the no bailout clause in their constitutions. So the ability for the states to run deficits is very limited, very limited. And you can tell how limited it is because the convergence is remarkable, actually. It's really very positive news for the US, and this is a striking difference with the Eurozone. In terms of cycle asynchronicity, well, the cycle actually converged before the crisis. After the crisis, the cycle diverged, and then is returning and even much better, in a much better position than before the crisis. So indeed, the US economy is pretty flexible in accommodating a massive hit, a massive shock to the economy and returning to the pre-crisis levels in terms of asymmetry, much more than the Eurozone. And the not so good news is competitiveness all across the 50 states deteriorated before the crisis, much more during the crisis, and is slowly, if at all, returning to the pre-crisis level. So this is not such good news for the US. And finally, and this is something that I want to put to you and discuss with you all in the Q&A session, in terms of monetary and credit dispersion in the US, dispersion is massive. Should we value this information as much as we do in the Eurozone, given that the US is a fully formed banking union? That's something for discussion. Is it really relevant for the US as much as it is for the Eurozone? That's something that we really want to discuss with you all.
Does this include the ESA balances?
There was?
The analog of the target balances in America,
ESA
balances?
We did not include ESA balances. We need to include it. We did not. No, we don't. Oh, this is something I said before. This is the comparison between the two areas with monetary indicators and without monetary indicators for the US, for the reasons that I said before. So here you have the USA without monetary dispersion, which is very much, not a flat line, but very much fluctuating along the initial value in 1999, the effect of the crisis, and then slowly returning to the pre-crisis level overall. This is this is the USA with monetary dispersion, much closer to the Eurozone. Yeah? So again, the point here is, should we take into account monetary dispersion in the US in order to make it comparable? Is it that relevant? That's for discussion. And that's it.
Well,
thank you very much.